Judgment Day.
Yeah.
See what the Fed says, not necessarily what it does, and what you all do based on what they say.
Right. Well, every time we do this, we say it's the most important one since last time. I think the Fed is in a decent position in fall because the calendar is sort of giving them a favor in the sense that they had a built-in pause in August. They could wait and see what the data said. They've got another built-in pause coming in October. They can wait and see what the data says. Right now, the data does not justify a move, either up nor down. It just sort of lets them stay on pause. As of this morning, the market says there is a 0% chance of them hiking. So I don't expect that we're going to get any big surprises today. But what I do think we're setting up for is that a 0% chance today and then only a 45% chance in November is really suggesting that they're done. So if they start to come out and, number one, have dissension among members that say, I think we should keep hiking, I think we should stop, that's going to confuse markets. And if they come out and continue to be really, really hawkish when the market thinks they're done, then we start to see volatility.
Yeah, you mentioned 50-50 basically for November and December if they're going to hike again this year. So, Stephanie Link, I think the words you're going to hear often today from the analysts who come on our air around the Fed, higher for longer. And if that is the case, if it's going to be higher for longer, what does that mean for the strategy that you'd employ in the market?
Well, I think we've been saying it's going to be higher for longer, or is it just high for longer? Either way, as Liz just mentioned, I've been saying you're in the 9th inning in terms of this cycle, this tightening cycle. But that being said, don't forget that QT is still happening as well in a very aggressive fashion. And so that will be restrictive in addition to these higher interest rates. So to me, though, I step back, Scott, and I say, you know, the economy so far, we've been able to handle higher interest rates. The consumer has been really impressive and goes back to jobs and to wages and to even retail sales from last week. How about housing? There are puts and takes within housing, but new home sales are up 31.5%. That speaks to demand from the consumer. Even permits yesterday. Single-family housing starts were also up. So there are pockets of the economy that are doing well. Manufacturing, we've talked about, because of the $2 trillion in infrastructure spend, the bills that have been passed, that's helping onshoring in that theme. Agriculture is doing fine. Anything tied to aviation is fine. So adding it all up, you're at above-trend GDP, and that is leading to above-trend inflation. And I just think that maybe they don't go today or in November. They're still battling with a core PCE at 4.2%, and they want that to be 2. So you ask what I'm doing. I'm not really changing. I do like the fact, my style. I kind of like the fact that the economy and the strength in the economy has led to less bad earnings. I think earnings are going to recover throughout the rest of this year and into next year. And we have seen a broadening out in the marketplace. We've been talking about this for months now. So I have had that broadening tilt to the diversification within my portfolio. I'm overweight energy. I'm overweight industrials. I even liked what some of the financial services companies have said at the Barclays conference in terms of better net interest income, better demand. Oh, by the way, better consumer demand from Bank of America today. So no change in my strategy, but I like the diversification. I think that's much healthier than just having the big 7 lead the way.
Well, you've made a big move as well in your book that we're going to get to in just a minute, so don't do it yet. But, Joe, you know, to some, it's not so much what the Fed does from here. It's what they've already done and the impact that is yet to have on the economy and then eventually the stock market. That's what Wolf is talking about. Now, Wolf has been skewed negative for a while, so just put that as a caveat. But they say the next leg down is to be driven by the lagging impact of past rate hikes, the old lag effect of what, you know, Chair Powell has talked about, what many have talked about since the Fed has done, you know, this 525 basis points in 14, 15 months or so, 11 hikes in all, and what it's all still going to mean, Joe.
Well, I think, first of all, that's speaking exactly towards what energy prices will do to the consumer over the coming months, and that is it's going to weaken spending, and I expect that the economy is going to weaken. You know, people are focused on oil prices moving higher and the inflationary effect of that. I think the real effect is going to be that consumer spending is going to weaken. So, you know, I think about today. 10 years ago, my son was stepping on the ice to play hockey. I told him, if you don't move your feet and work hard, I'm not going to let you continue to play the sport. 10 years later, he's still playing the sport, and I'm telling them the same thing. So I think you're going to get that threat, but you're not going to get the actual promise. I think the Federal Reserve has to be hawkish, but I think they're remaining on hold. And I don't think they're going to go in November. And the reason I don't think they're going to go in November is because I do see a weakening economy. I do see a UAW strike that's going to create a little bit of friction for them. And then you also have the potential for an October government shutdown, a low probability, but it is still there, Scott. So I think the Federal Reserve is basically done.